What if I told you that your investment portfolio isn't just a savings account for the future? Consider it a tool with near infinite applications that the wealthy use to do things that the rest of us never even consider. Some things they do you may have already heard of. They include leverage, like borrowing against your assets, tax optimization, like tax loss harvesting that we see toward the end of the year. Or, as the title of this video alludes to, it could even be insurance as a hedge against a real world risk, or to benefit from something that you don't want to happen. So, welcome everybody. This is going to be my deep dive on Open Door stock and an explanation as to why I'm buying it as a hedge against the housing market. So, to verify the viability of this strategy, I believe it's necessary to evaluate the meme stock title given to Open Door Technologies and come to our own conclusion about whether or not it actually deserves this title. Before we get too far, I do feel like it's necessary to kind of give you guys a little bit of perspective as to where I'm coming from with this stock. This stock first came onto my radar right about here. It's going to be about July the 17th. I remember being at the car dealership waiting for my oil change to be done, and I was kind of being bombarded by Yahoo Finance um, about this stock that had increased like 100% or 80% in a day or whatever. So I very briefly looked at it, kind of brushed it off, and over the weekend ended up doing some more research on it. Ultimately, I ended up buying high and selling low multiple times and coming out at a net loss with the stock. It kind of really irks me that if I had held any of these buys until today when the stock was $7.20, I would be looking at about like a 350% profit in a month or two. So anyway, that's where this research basically started from. A lot of my initial research holds true, but having had time to really digest the information and write it out and feel much more strongly about my position is effectively what the rest of this video is going to be about. So, to determine whether or not Open Door is a meme stock, we kind of have to define what a meme stock actually is. The term meme stock became mainstream during the COVID-19 pandemic, with the 2021 GameStop event being the most notable example. I actually began investing on June the 1st, 2024. I funded my account on this day and made my first purchase of a stock when the market opened on Monday, June the 3rd. Despite this being the when I actually started investing, I was very acutely aware of the 2021 GameStop event. That event actually is what got me really to consider investing as a wealth building tool. So yeah, if that actually didn't happen, I don't think I would be here doing, what I've been doing. Here I have a checklist of the key characteristics of a meme stock. We're going to see exactly how many of these Open Door fits into to help us come to our conclusion. So first off, meme stock is generally retail investor driven. Trading in meme stock is primarily driven by individual or retail investors who organize online. For the most part, this is true. The next on our checklist is social media hype. Momentum is generated through online discussions and viral trends, with investors using specific slang, blah, 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 blah. I don't actually spend any time on Wall Street bets or any forums, so I have no idea whether or not this is the case. However, I am going to count Eric Jackson's public endorsement on the news as social media hype, as media hype. So either way, that's going to fit the bill. Disconnect from fundamentals. The stock price often becomes detached from the company's underlying financial health and future growth prospects. We're going to come back to this. We're going to go over everything in detail. Extreme volatility. I mean, I can pull up the chart for, or yeah, I can pull up the stock chart for about a second, and that is without question. We have had near 300 or 400% return in the past 6 months, and a lot of that has come within the past month or month and a half. It definitely is volatile. And then high short interest. Meme stocks often have a high percentage of their shares shorted or bet against by large institutional investors. I'm going to say that's definitely true, and it's not without good reason. So overall, we are looking at a stock that fits 4 out of our 5 key characteristics, like main drivers, to be considered a meme stock. It definitely makes sense why the media has given Opendoor this label. However, since I began investing on June 1st, 2024, several stocks have been labeled meme stocks. In my 15 months, I have 4 other examples, and we're going to go over a couple that I would definitely agree deserve the title and a couple that really don't, and we're going to discuss what made them different. So first up, I'm going to pull AMC up. So about a year ago when I started investing, I remember this was a $5 stock. Uh, I had looked into it and ultimately came to the decision that I did not want to buy it. Uh, Looking back, I'm pretty glad that I came to that conclusion. But I remember that the company was very riddled with debt the industry just holds a lot of uncertainty, and a majority of the trading does come from hype. So this would definitely fit the characteristics. Krispy Kreme is another one. I've not actually looked into any of the financial metrics. However, from here, at a glance, I can see that the company is not profitable, has a very small market cap, and has depreciated near 75% in the past year. Definitely don't think I would want to be in that one. Here we have a couple that are kind of on the other side of the aisle when we're talking about meme stocks. So Palantir Technologies, about a year ago when I started investing, this company was $21. It had, the past 3, 4 years prior to that done next to nothing with a lot of hype, a lot of negative sentiment from the media, and very strong accusations of it being a meme stock. The difference that Palantir, the difference between Palantir and the other ones we discussed, like AMC and Donut or Krispy Kreme, are that during this entire time, the fundamentals of the company were growing. They were getting stronger every quarter until finally we hit this inflection point pretty much toward the end of last year. Um, it finally lost that title, and you can see the massive gains that we've seen since then. Another stock very similar to that is going to be SoFi Technologies. When I first started investing, I could buy shares of this stock for like $6. In fact, I did pick up around 100 around there, and I got the remaining 200 or 300 on its way up. So I have a good 300 shares at a cost basis of like $13. But either way, the fundamentals of this company have been improving for the past like 17 quarters, and their growth is just phenomenal. So for both Palantir and SoFi, all 4 of these boxes would also be checked. But the disconnect from the fundamentals, while is very true, was actually in the opposite way that this checklist intends to reflect, right? They're trying to say that the fundamentals are horrible and they do not deserve the stock price. However, the fundamentals of both Palantir and SoFi were so great, the stock deserved to be trading higher. And us retail investors caught on to that before the institutional investors and mainstream media. Having said all of that, let's dive on over into Qualtrim and check out the fundamentals for Opendoor. Here I have the quarterly trailing 12 months pulled up just to kind of smooth out the view for us. Either way, this stock's business has been in decline for several years. The the high interest rate environment has made their iBuying business model struggle significantly. And that's very apparent in the numbers. We can see from the massive revenue increases in the last couple quarters of 2021, the peak in 2022, and we've just gone downhill since then. As interest rates have gone up, their revenue has gone down, their earnings per share has gone horribly, their free cash flow, again, as revenue has declined, their free cash flow has gone down. Despite all of that, when we are looking at a stock that is going to go under, we're looking at declining cash flow, which for the most part has been true. Declining revenue, definitely been true. Pressure on margins, definitely been true. Increased reliance on debt. So the most recent quarter kind of throws a wrench into this very condensed outline that we have, right? This is by no means all inclusive. But the most recent quarter, we've actually seen positive free cash flow again. If you look at the debt, the company's actually been paying down its debt. If it were going out of business, we would expect that debt to be increasing. They would need the debt to finance operations, to pay their employees and all of that, right? So, long story short, the company's been in some of the hardest macroeconomic environments that it could be in. And despite that, everything's actually trending up. That leaves me very optimistic for when rate cuts actually arrive. Um, as you can see, even here, the profit margins this past quarter were starting to inflect positive. We're at the point where I believe if the company were to go under, it should have already. I believe we're already in that turnaround phase. So I absolutely actually cannot say that this applies. And because of that, it has me leaning more toward the Palantir and SoFi type of meme stock rather than the AMC or Krispy Kreme. Beyond just the speculation and saying that they should have already if they were going to, the company's been actively taking steps to improve its financial position. They've shifted their strategy to a more capital light, resilient platform business type model. They're not completely abandoning the iBuying, but they're making that a much smaller, more disciplined part of their business. They're being much more mindful of the profit margins on their properties, and they have significantly reduced their buying, and they are trying to offload a majority of their inventory on hand. As part of this platform business model, the goal is to move away from just being a house flipper and to become a full service real estate platform. They're broadening their solutions. They're offering mortgages, title and escrow, home insurance, and warranties. Basically, their long-term vision is to create an ecosystem of services in the housing market. And if rate cuts are to do the job that we're expecting them to do, they should benefit significantly, um, especially with all of these initiatives to improve the business. It'll, in theory, should increase margins and make them much more profitable. Everything up until now has effectively been going over their financial metrics and their initiatives, and it's effectively been what the company has been doing to turn itself around. Overall, I believe they will be successful in the business turnaround. However, there's another part of this investment that I really hope intrigues some, if not all of you. That's going to be the personal hedge. So again, the market is expecting rate cuts in September. This in theory should increase market transactions, which would create an environment that Open should thrive in. I live in the heart of Phoenix. I'm 5 minutes from Tempe. I'm 5 minutes from ASU, 5 minutes from Sky Harbor, I, which is the major airport. Um, my local market is where Open Door was founded, and it's also its most mature market. It's where they conduct most of their business. If the Phoenix market recovers and transactions increase, Opendoor is likely to see the turnaround investors like Eric Jackson are speculating about. This would be the full turnaround, everything that I've discussed up until now. However, if rate cuts fail to stimulate the housing market and the company continues its decline or goes bankrupt, I lose my investment. However, that also will likely mean that I'm in a good position to meet a major financial milestone and personal goal of mine, which is to buy my family our first house. This creates a win-win scenario. By limiting my position size in Open Door, I can manage my risk while, in a way, purchasing insurance against the housing market. Because if the market goes up and my goal becomes harder, then at least my investment will have made money to make up for that. In the event that I lose with this investment, I'm actually excited because I'm in a better state to meet that personal goal. In other words, I'm not just speculating. I'm making a calculated bet on a company that will succeed if my personal goals become more difficult to achieve. So that's going to be it for this one. I really hope you enjoyed. If you could please go down below, hit the like button, subscribe while you're down there, leave me a comment, tell me how I can improve. I would also like to hear from you. What ways have you guys used your portfolio in the past that most conventional investors had not considered? I hope you have a great rest of your day, and I'll catch you later.